Let's go back to the year 2020. The World Health Organization declared a coronavirus pandemic. This news sent shockwaves to the world economy. Airlines, leisure facilities, oil and gas drilling, auto parts and equipment, and restaurants took a major blow from this news. The stock market reacted to the news, and selling intensified during the first half of March to mid-March. During this drop, there were multiple severe daily drops in the global stock market. Many people lost their jobs and wanted a source of income. And this is where the boom of day trading started. Many Americans took advantage of their time stuck at home and invested their $1,200 government check in the stock market. Some were successful while others weren't. But one thing was certain, and that was a shift in a trend. Amidst the rise of day trading, Robinhood became extremely famous. The number of users on the app grew from 500,000 in 2014 up to 13 million in 2020. People were quick to jump on the day trading bandwagon despite the controversies surrounding Robinhood. Robinhood faced a lot of criticism during the boom of day trading. Before we begin, I will appreciate it if you can smash the like button, subscribe, and turn on the bell notification. It will help me and my channel a lot. Now let's dive deeper into those controversies so that you can get a clear insight. The first blowback happened when Robinhood decided to freeze the trading of GameStop on January 28. Shares of the video game retailer skyrocketed after traders on Reddit began aggressively buying the company's stock. Robinhood played a critical role when a group of Redditors saw an opportunity to make money while also giving a jab to Wall Street and hedge funds. However, Robinhood made the surprising move to restrict buying GameStop, citing issues with volatile stock and regulatory requirements. Due to its part in the trading frenzy, Robinhood has been scrutinized by its users, regulators, and lawmakers. On the morning of January 28, Robinhood posted a blog saying it was limiting users by preventing them from buying stocks from several companies such as GameStop, AMC, and Nokia. It cited market volatility as its reasoning and would only allow customers to sell their shares of these companies, not buy or trade in any other way. Wall Street Bets, the subreddit, expressed their concern on Twitter by saying that this move by Robinhood harmed the small-time traders while the big whales on Wall Street were benefiting from it. Robinhood users flooded the Google Play Store and Apple's App Store with negative app reviews. There were so many one-star ratings that Google intervened to remove tens of thousands of them. All this led to a lawsuit being filed on January 28 in the Southern District of New York accusing Robinhood of purposefully, willfully, and knowingly removing the stock GME from its trading platform in the midst of an unprecedented stock rise. But this controversy wasn't stopping new traders from jumping onto this platform and trying their luck in day trading. Now, if you thought the controversies ended here, you are wrong. The Financial Industry Regulatory Authority recently levied its largest fine ever against Robinhood. Robinhood is supposed to pay $57 million in fines in addition to $12.6 million in restitution to customers. FINRI is a nonprofit, self-regulatory agency that oversees member brokerages and exchanges. Over the course of its investigation, FINRI found that Robinhood violated certain regulations and presented false and misleading information to its users. Even though Robinhood turned off the option to trade with borrowed money, some customers were allowed to place trades. Others saw inaccurate negative cash balances. Robinhood also failed to report a variety of customer complaints to FINRI, the regulator said, and suffered a number of outages from 2018 through 2021 that caused customer losses, most prominently during the GameStop stock surge. FINRI determined that the outages and system failures were partially due to the lack of a proper continuity plan. Robinhood neither admitted to nor denied the charges. The head of Robinhood's public policy communication, Jacqueline Ramsey, stated, "Robinhood has invested heavily in improving platform stability, enhancing our educational resources, and building out our customer support and legal and compliance teams. We are glad to put this matter behind us and look forward to continuing to focus on our customers and democratizing finance for all." Despite these controversies and fines, newbie investors opened their accounts on Robinhood. They poured their savings without any prior knowledge regarding the stock market. And this is where we move on to the next theme of this video. So, let's say you have made up your mind that you want to be a day trader. The only question you should ask yourself is, how can I polish my skills and identify stocks for day trading? First, let's understand the art of picking stocks in day trading. And then we will switch our focus towards polishing your skills. I don't know much about day trading, so I asked a few of my friends. Shoutouts to Yons.fx, Build a Trader, and OptionStender for these tips. With the rise in popularity of short-term trading, many new traders are jumping on this bandwagon. Chasing short-term profits is a really risky investing strategy. If something goes wrong, you could be stuck with an investment that can't withstand a downturn and have massive losses. In general, it's far better to buy solid investments that you want to hold onto for the long term, since it's very difficult to time the market. If you invest in the long term, you should still make money over time because your assets will be able to recover and grow whenever the market crashes or dips. However, the gains in day trading are massive, thus making it attractive. Here's a pro tip: educate yourself first and don't get into day trading unless if you know what you are doing, since the success rate is low due to a lot of people not knowing what they are doing. If you do know what you are doing, the first step is to have a good setup. For day trading, you want to go for a quad-core setup with at least 2.8 GHz through 3.3 GHz or more is recommended. Day traders use a lot of techniques such as scalping. This strategy attempts to make numerous small profits on small prices changes throughout the day. Range trading. This strategy primarily uses support and resistance levels to determine buy and sell decisions. News-based trading. This strategy typically seizes trading opportunities from the heightened volatility around news events. High-frequency trading. These strategies use sophisticated algorithms to exploit small or short-term market inefficiencies, etc. Another tip is that you need to pick the right stocks. Go for big companies such as Tesla. Selecting the right stock for short-term gains can help you shape your mindset and investment decisions. However, there are plenty of factors you must keep in mind before pouring your money in any stock. As a new trader, you must understand how to pick stocks using the moving average. A moving average is the average price of a stock over a fixed period of time. Moving averages can range from 15, 20, 30, 50, 100, 150, 200 days. The moving average is usually a line in an upward trajectory during a bullish market and downward trajectory during a bearish market on the stock chart. Now, when these two lines intersect, that's the time to buy or sell a stock. For instance, if a chart is showing the 50 DMI line crossing the 200 DMI line from below, you can quickly identify the buying opportunity as there is more upside potential to the stock. The second trick you can use is to pick potential stocks is through chart trends. The moment you open a stock chart, you will be flooded with different trends. Now, as a new investor, it will be difficult to observe which trend represents what thing. However, with consistency and discipline, you can easily observe the chart trend and identify the stock. Usually, when the stock is bullish, you will identify an uptrend, and you can utilize this trend to invest your money in that stock. This brings us to momentum investing. Momentum investing is the buying and selling of stocks that have the potential to make massive price jumps in a short span of time. As an investor, you can pick the stock that is about to soar and sell it at a higher price. But the question is, how will you identify the stocks with momentum? The first option is by using the rate of change indicator. The rate of change indicator is a generic momentum oscillator. This indicator measures the speed at which the stock price is changing within a specific time span. It calculates the percentage change between the most recent stock price and the price that existed a specific period ago. It is a value greater than 0 reflects a spike in upward momentum, and a value less than 0 suggests a downward momentum. The second indicator you can use is the trading volume indicator. The trading volume is a great tool that will help you observe the activity taking place around the stock. The stock supported with higher trading volume shows that the stock is a hot pick with lots of upward momentum, and lower trading volume indicates a lesser interest of traders in the stock. The important thing to consider is that short-term trading involves sheer commitment and excellent risk management. Many new investors pour their money to aim for short-term gains, but they do not know how to identify the hot stocks for juice gains. You must try all the strategies and select the one which suits your trading style. And soon enough, you will have the eye for identifying the most promising stocks. Don't forget that you don't have to use every indicator that is mentioned. One of my friends, Build a Trader, recommends only using 2 moving averages since indicators usually lag. He also believes price action and market structures are the most effective. Just like with investing, learn how to control your emotions. Day traders use only risk capital which they can afford to lose. Not only does this protect them from financial ruin, but it also helps eliminate emotion from their trading. However, there is a big difference between investing and day trading, and it's important to know the difference. The indicators mentioned above are good to some extent. They do not promise a solid return, nor are they the key to success in the trading world. Trading is 90% psychological, and the rest is covered by the technical analysis, emotion, thinking quickly, and exercising discipline are components of what we makes up trading psychology. There are two main emotions to understand and keep under control: fear and greed. When traders get bad news about a certain stock or about the economy in general, they naturally get scared. They may overreact and feel compelled to liquidate their holdings and sit on the cash, refraining from taking any more risks. If they do, they may avoid certain losses but may also miss out on some gains. Traders need to understand what fear is: a natural reaction to a perceived threat. In this case, it's a threat to their profit potential. Fear is not necessarily bad because fear gives you a sense of empowerment. Not only is adrenaline released when you feel fear, but other chemicals as well, such as dopamine, endorphins, oxytocin, and serotonin. There's a good reason for that. Serotonin, in particular, helps your brain to work more efficiently. Fear is energy and evokes us to action. Traders should consider what they are afraid of and why they are afraid of it. By thinking it through ahead of time, traders will know how they perceive events instinctively and react to them. Of course, this is not easy, but it's necessary for both the health of an investor and her portfolio. This brings us to overcoming greed. There's an old saying on Wall Street that pigs get slaughtered. This refers to the habit greedy investors have of hanging on to a winning position too long to get every last tick upward in price. Sooner or later, the trend reverses and the greedy get caught. Greed is not easy to overcome. We all have the desire of having more, and this is the origin of greed. To combat greed, practice gratitude. Research also shows that gratitude can lead to increased concentration, enthusiasm, optimism, and satisfaction, not to mention improved sleep quality and a greater sense of connection to others. As a trader, you should learn to recognize this instinct of craving more and develop a trading plan based on rational thinking. A trader needs to create rules and follow them when the psychological crunch comes. Set out guidelines based on your risk-reward tolerance for when to enter a trade and when to exit it. Set a profit target and put a stop-loss in place to take emotion out of the process. The whole point of trading is to make money. If you are up on a certain day, you should keep aside the greed element and take the profit. Your aim should be to close the trade on a profit. And if it falls under your stop limit, then let go of the stock position. Traders need to become experts in the stocks and industries that interest them. Keep on top of the news. Educate yourself and, if possible, go to trading seminars and attend conferences. News provides the majority of opportunities from which day traders capitalize, so it is imperative to be the first to know when something big happens. Consistency is also very crucial. The only thing that destroys consistency is not consistently taking the profits and managing risk. Day trading is only profitable in the long run when traders take it seriously and do their research. Day trading is a job and should treat it as so. Obviously, there will be days when you will go home with heavy losses. But if you are consistent and disciplined, there will be days when you will double your money. Are you a day trader or interested in day trading? What strategies work for you? Do let me know in the comments below. Thanks so much for watching, and I'll catch you next time.